Hello, everyone. Welcome to the webinar. Time is 11. We will start. I am your host, Joyce, a financial advisor at Saturn Advice. Thank you for taking the time and being here today. I hope you do enjoy the next hour. Now, we still have some people joining in, so I want to take this time just to go through some housekeeping stuff with you. So first of all, thank you for those of you who has already submitted your questions in advance. We do have a live Q&A session at the end of the webinar. Therefore, we have enabled the question feature, which is located at the left-hand side of your screen in the auditorium. So if you have any questions throughout the webinar, please do pop them in there. Secondly, if there is a fire, please make sure you do evacuate. Please don't stick around for the webinar. Don't worry, you won't miss a thing because we will send you an on-demand recording in the coming days. For those of you who just joined us, thank you and welcome. Now, let me introduce today's topic and our panel speakers. So we've invited three experts in their respective field to share their knowledge and opinion on topic that's front of mind for our investors, which is navigating the new tax laws for property investors. What are your options? On our panel, first up, we have Kenina Court. Kenina is a founder of Pathfinder Solutions, a chartered accountant and advisor with over 25 years hands-on experience in advising property investment clients. Also on the panel, we have Shahrukh Abdali. He is a financial advisor at Saturn Advice and a CFA charter holder, which is one of the highest distinction one can get when it comes to asset management profession. Shahrukh has vast experience in investment banking, corporate finance, and portfolio management. Last but not the least, we have Lisa Dudson. Here is a wonderful smile there. She is owner of Acumen, a director and shareholder of Saturn Portfolio Management Limited. She is an investor, entrepreneur, and seminar speaker, one of New Zealand's leading personal wealth educator. Welcome all three of you. Thanks for being here today. Now, without further ado, let's kick it off. And also importantly, a general note for our audience today. The information presented here and opinion shared are general information only. These are not personal financial advice. So we do encourage you to seek personal financial advice, which takes into account your unique personal circumstances. Well, let's kick it off. I'll come to you first, Kenina. I still remember the day that John, our managing director, stormed into the office, sounding all surprised and asking if we've heard about the new housing policy changes. I quickly went online, surfed different websites for 15 minutes. I have to say, I ended up with more questions than I started off with. So I'm going to ask you the most obvious question here. So what are the policy changes and how are they impacting our investors?
Well, it's a good place to start. I guess back on the 23rd of March, when the government made what, in my personal opinion, can only be some very short-term decisions about trying to make some changes on the property market. They introduced a number of things. Some of them directly impact property investors, others not so much. One of the first things that they brought in was to increase the bright line test from 5 years to 10 years. Because apparently there's a whole bunch of property investors who sell property after 5 years and make a killing and don't pay any tax on it. So that is going to be an issue for property investors in terms of how they own their property, because 10 years is a long time. However, I guess the one concession that they did make in that was that they didn't increase the bright line test for brand new property. Before COVID, New Zealand had well over 40,000 houses short in terms of the people who wanted to buy houses and there being a house available for them to buy. So by keeping the bright line test to 5 years for brand new properties, it's very clear that what the government is wanting to do is to encourage new houses to get built, mainly for homeowners, but a good portion of those, because property investors make up about 30% of the house buyers, a good portion of those will get bought by by property investors. The second thing that they did as part of the bright line test was that they're going to have this thing called a change of use adjustment on your family home. So your family home is completely excluded from the bright line test as long as you live in it the whole entire time that you own it. So as soon as you move out, so for example, you're living here in New Zealand, when the borders open, you might want to go offshore and get some overseas experience. So you keep your home back here in New Zealand because your intention is to come back. And over the time that you're away for, say, 3 years, you decide to rent your property out rather than leave it empty. So when you go to sell your property, and let's say you sell it and you come back to New Zealand and you sell it 3 years later, if you'd owned that property for, let's say, 6 years at that point, then whatever the capital gain is, it has to be divided by 6 because you owned it for 6 years and multiplied by 3, and whatever the gain is for that portion, you have to pay tax on that even though it was your family home, because you were not living in it for the whole entire time that you owned it. So that is a bit of a big thing that's going to affect a lot of people. The next big thing that the government brought in was that they introduced a rule, because apparently when we as property investors deduct our interest cost, that's a loophole. And that loophole means that we're able to offset our interest cost against the rental income that we receive. The argument being that because no other investment is able to do that, for example, you can't borrow money to buy shares in quite the same way. So therefore, property has an advantage over share investing because of the fact that you can leverage it as an investment. So over the course of the next 4 years, depending on when you bought the property, the ability to claim interest is going to be phased out. Starting with the 1st of October is when the first change comes in. If you bought the property prior to the 27th of March, then your finance will phase out down to 0% starting from the 1st of October. If you bought your property after the 27th of March, or took out new finance on an existing property, the interest deductibility on that will stop on the 1st of October of this year. So that's going to bring quite a considerable new cost into the profit and loss account of many property investors. Maybe not so much in the first year for existing property investors, but certainly from year 2 onwards, people are going to start feeling the pain of that extra tax bill kicking in. And unfortunately, what that will mean for many tenants is that their rents will have to increase. And with having the rents increase, for a lot of our clients, we've worked out that needs to be $90 or $100 a week over the next 4 years is what rents will have to go up by just to cover the cost of the tax. So that's quite a significant change for property investors. However, again, because the government is wanting to encourage property in terms of new builds to be made, existing houses have that phasing out, but brand new houses have 100% interest deductibility the whole way through. Property developers and property traders, so anybody who counts property as a stock item versus counting it as a fixed asset, they are still going to be able to claim 100% of their interest. So our property developers and traders don't need to worry about that just yet. So sort of just closing that in summary, what that will mean is that the date of acquisition will be very important in terms of the 27th of March, whether you bought before or after that, or whether you took out debt before or after that. Because that's the line in the sand that the government have chosen. Why they couldn't choose the 1st of April or the 31st of March, nobody knows. But the 27th of March is going to be one of those D-days from a property investor's point of view.
Thank you, Kenina. That's very helpful. Just a couple of things. I see chats coming through. David was asking about if this webinar will be recorded. The answer is yes. There is also another chat message saying there is a bit of feedback in the background. So I tried to mute Shahrukh and Lisa, but it's not quite working. So maybe you guys can try again, see if you can actually put your turn the mic off. Kenina, thanks very much for that insightful knowledge. Now, my follow-up question on that is, obviously, whenever there is a question, whenever there is an action, we can see a reaction. So with the new housing policy being introduced, the extension of bright line test and the removal of interest deductibility, what are you actually seeing in your clients at the moment?
It's a bit of a mixed reaction. 95% of property investors only own one property. And so many of them are mum and dad investors who thought that buying a property would be a good thing for them to do to help in terms of, their retirement at some stage in the future. Which means that 5% of property investors own one or more properties. So for many of our single property investors, they're okay, they're just going to ride it out. They'll be very anxiously awaiting their rent increases, which we can now only do once a year. Those rent increases are going to become more important in the future because we can't squander them in perhaps the way that we might have done in the past. We're really going to have to use those quite strategically to make sure that we get that increase in the rent to help going towards the cost of the tax bill that's going to increase. Some of them have a mixture of property that is residential and commercial. So we'll be going through a refinancing exercise to try and move residential debt onto commercial property because none of these rules affect commercial property. So commercial property is probably going to increase in value where those prices are comparative to what somebody would have spent on their housing. So if you're looking at $1 million commercial property versus $1 million home to rent out, the commercial property is, even if it's got a slightly lower yield, is probably going to be better over the long term simply because you'll have 100% of interest deductibility. Outside of our client base, we've had a number of conversations with people who aren't clients. It's scared them off from getting into the property market because they just don't know what that's going to look like, and they'd rather wait for things to settle down and see what happens. Some people are thinking that it's going to lead to a market crash. I don't see that happening. I think we've got too much latent demand for that to occur. In general, I think people have just, where they might have wanted to work with the tenant and that they were very mindful of how much the rent was as part of the tenant's overall living cost, and they might have shared that burden with the tenant, there's probably going to be less ability to do that in the future because any business, when it has its costs increase, it has to get that cost back from somewhere. And unfortunately, in a residential tenancy agreement, generally you've only got one customer. And that one customer is the person who will end up bearing the cost of that. The government has signalled that they might think about putting in place some rent controls. I can't see how that's going to be effective, and is more likely to lead to property not being used in a manner that would actually make it efficient. So that might mean then that, a family moves into a 5-bedroom home, and because they've got some good rent controls on that, the kids grow up and move out, but they'll stay where they are, which means that we've got potentially 2 or 3 bedrooms that are now not being used. And there's just a family of potentially 2 people rattling around in this really big house. So what that would mean then is that the issue that we've had with overcrowding in the past could become a much bigger problem in the future.
Yeah.
So it's really going to take some time for the dust to settle. And of course, none of this as legislation has actually been passed yet. It's still going through that whole bill going through Parliament phase. So once it comes into legislation, then we'll have some clearer ideas on what we want to do and what we should be doing. But I guess what I would be saying to any existing property investor is to think carefully about what your long-term strategy is before you just turn around and do anything. Certainly, there will be some other asset classes that might become a little bit more interesting now that we've lost interest deductibility. But let's wait for the dust to settle before we sort of rush in and make decisions about selling major assets, because we don't know what's going to happen in the market.
Thank you, Kenina. That's very helpful. And overcrowding and rental increases are certainly unintended consequences of such government policies, isn't it? I remember yesterday I was watching one news, and you are certainly right. A lot of investors are now taking a wait and see approach. It was talking about houses getting passed in the auction room, and also the number of applications to the bank for applying a home loan has actually dropped by 11%. But of course, that with a caveat that we are exiting summer, heading into winter, which is traditionally a slowdown period for housing market.
Yes.
Now, I'm going to turn my question to Shahrukh now. Shahrukh, in the investment world, we love to talk about rate of return, right? So I know it's a bit of a crystal ball gazing question for you, but with all these policy changes, removal of interest deductibility, what kind of impact do you think it's going to have on the rate of return for residential investment properties?
Oh, thanks, Joyce. It's a good question, and I'll agree with Kenina on her views quite a bit, because I do think that all things equal, the new proposed changes will have created a lot of uncertainty, particularly for a certain type of property buyers, i.e., property investors with multiple properties. But even so, for the normal mom and pop property investors looking to buy property for their retirement, there's a lot more to think about. So the demand side of the equation will be negatively impacted as a result of these proposed changes, at least over the short to medium term, until, as Kenina said, the dust settles and we get a clearer picture of the underlying impact. I also agree that I do not think that the property prices are going to fall off, as some commentators initially might have indicated. I think fundamentally there is still a lot of demand for properties. As Kenina pointed out, there is a shortage. It was there pre-COVID. During the COVID era, there were a lot of overseas expats who returned to New Zealand, and that demand was very much there when we came out of lockdown, and we saw a surge in property prices as a result of that increased demand, and obviously the interest rates were dropped by the banks, and the LVRs were taken off. So I think the most likely scenario coming up over the short to medium term, over the next few months, is flat prices. There might not be an increase in price, but at the same time, I don't think that fundamentally there are factors pushing the prices down materially. But yes, there will be a slowdown in the property market, what we've seen over the past few months, particularly coming out of the COVID lockdowns. I don't think that is a repeat scenario coming up.
Thanks, Shahrukh. So staring into your crystal ball, the verdict is that the property price is likely to be flatlined, but there is unlikely to be a crash. So with that in mind, what does investors do? Are there any other options outside of residential properties?
Thanks for asking that question. From my experience, I have found that the typical Kiwi investor is very familiar with property investing. It's a Kiwi thing to own a quarter-acre piece of land with a property on it, not just for themselves, but also for investment point of view. The other most commonly used investment option is term deposits. And then there are a few investors who dabble into some shares. So I think it's a pretty good idea for me to sort of take through the audience with all these different investment options and what are the advantages as well as the risks to consider when deciding on which asset class or which type of investment is good for them. So starting out with the first one, which is really simple to understand, is term deposits. Generally, investors don't really need advice to make an investment in term deposits, which means that there isn't really any cost involved in investing in term deposits. The transparency of returns is really, really good because you know what you'll be getting investing into term deposits. The downside is that in the present interest rate environment, the returns are really, really low. Most major banks are offering less than 1% return on term deposits going up to 5 years. And with inflation at 1.5%, that essentially means that term deposit holders are actually going backwards in terms of purchasing power on their investments. The other thing I would like to point out is the lack of diversification with respect to term deposits. While they are considered really safe, at the end of the day, they are an investment with a financial company. Bank is generally not considered a company. It's not perceived to be a company, but it is, at the end of the day, a financial company. And history has thrown a lot of curveballs in that respect. We've seen some really big financial companies go bust. Not suggesting that New Zealand banks are vulnerable by any means. They were very well capitalized, particularly following the GFC with the capital reserve ratios. So I don't see that a likely scenario, at least on the face of it. But it is always good to diversify your investments across different asset classes, different companies, different industries. So investing a large chunk into just term deposits is probably not ideal. The other thing is the lack of liquidity. So if the term deposit holder wanted to use up some of the money that they had put into a term deposit, it's essentially locked until the term, unless they are willing to forfeit most, if not all, of the interest that's been accrued. The last thing I do want to touch upon with term deposits is in my discussions, I've often come across people who think that term deposits are guaranteed. They're practically bulletproof. Well, they're not guaranteed. They were until the GFC happened. Since then, the government introduced the open bank resolution, which allows the banks to freeze the deposits, including the term deposits, use the deposits to practically pull themselves out of the financial troubles that they might have landed themselves into. And that would mean that term deposit holders might take a haircut on their deposits. So while the risks are low, it's not that term deposits come without any risk. Next one, as I said, is shares, and I would also throw in that mix investing in bonds. And I'm talking about shares and bonds which are listed on these exchanges, on the New Zealand exchanges and exchanges all over the world. The good thing about investing in shares and bonds, you can customize your exposure across different regions, across different industries, and you can generate an income. Shares obviously pay out dividends. Most of the audience would be familiar with how dividends work. They are at the discretion of the directors of the company, and they are a share of the earnings that the business makes. For bonds, for those who do not understand bonds or are not familiar with that, a bond is essentially a loan to the company that has issued the bond. So if you buy a bond, you are essentially giving a loan to the company, and the company is going to pay you interest on it. But that is called coupon. So there are coupon payments on bonds that can be an income from that particular investment option. So there can be income. The caveat to that is a lot of analytical research has to be done in order to choose the right type of companies in the right type of industries in the right part of the world at the right time. So there is a lot of work involved in making an investment directly into shares and bonds. And having been a portfolio manager in a previous role for BNZ, I can appreciate the time that goes into not just the skill set and the experience, but the time that it requires to stay on top of the directly held shares and bonds, and knowing when to actually come out of certain investments and replace that with something else that might be looking good. It's not ideal for someone who hasn't really worked as a portfolio manager to be dabbling into shares, because that can be quite risky, and particularly those who do not do that as primarily their day job. Some people who would be investing in shares would be doing that as an evening thing, a couple of hours in the evening or a few hours over the weekend. That's just not enough. And to highlight the risk of it, we've seen over the decades, every time there is a big economic downturn, a big recession, whether that be the '87 crash, which some of the audience might have experienced or might have heard from their previous generations, and then we had the dot-com crash, the GFC. All of these events have resulted in some of the companies going bankrupt. And if you've invested in, say 10, 15, 20 companies, and that too just in New Zealand, as is most often the case with the people I talk to here in New Zealand, it is quite risky, because New Zealand is a very small part of the global landscape, and you're limiting your exposure to a very small basket, a concentrated basket. So not to suggest, New Zealand companies generally are bad, but they are pretty small on the global landscape. So if there was a big economic downturn, particularly New Zealand, focused, it can result in capital loss if some of the holdings in client portfolios or investor portfolios go bankrupt, because you can't really recover anything out of any company that's gone bankrupt. Shareholders generally come pretty low in the pecking order when a company is liquidated, as Kenina obviously can endorse. In terms of what I would prefer for my clients is going through managed funds. So just to explain how a managed fund operates, investors generally pool in their resources, and that pool is then invested by a professionally qualified portfolio manager, who then decides where that money needs to be invested. And his decisions or her decisions are driven by research that's been produced by a team of analysts working for him day in, day out, looking at specific companies or specific industries across different parts of the world. So that kind of structure is pretty robust in terms of choosing the right types of investments. Other important bit about managed fund is the diversification. So typically, a managed fund would be investing in about 30 to 50 companies. Some fund managers invest in more companies. There are examples with hundreds of companies of investments within a fund. But what I'm trying to say is that the risk of capital loss is much more subdued as a result of this diversification. Typically, a client of mine would be invested in about 12 to 15 funds that are spread across different asset classes. Some of them would be New Zealand fixed interest, global fixed interest, infrastructure, even listed property stocks, and then there will be shares in New Zealand, Australia, internationally. If you're investing, through managed funds of 12 to 15 companies, you essentially have an exposure of about 300 to 500 companies, which have been carefully chosen by suitably qualified and skilled people. It is quite unlikely that a large portion of those companies will go bankrupt as a result of an economic event, and you lose a large portion of your capital. The diversification is really good. The liquidity is really good. Typically, as with shares and bonds, if you wanted any amount of money, you could simply press a button, or you can tell your advisor or broker to sell some of the assets that you hold, and those can be converted into cash in a relatively short period of time. We know, as I've talked, term deposits, you can't do that unless you're willing to forfeit a large part of your interest. And with property, as the audience would be quite familiar, it takes some time, quite a few weeks, in order to be able to sell a property. But with shares, as well as with managed funds, typically the time frame is much shorter, usually less than 2 weeks. The other bit that is important to understand about managed fund is the income side. So property investors are very fond of generating passive income through rental payments. You can do the same through managed funds. Obviously, shares pay dividends, and then bonds pay out coupons. One point to note that shares, as I said, are at the discretion of the directors. Dividends are paid out if the directors feel that they need to share those earnings with the shareholders. But in financially turbulent times, as we are going through right now, quite a few companies can suspend their dividend payments, as we've seen in New Zealand as well. So a lot of my clients who were dependent on dividend payments obviously are now a bit concerned about generating income from just those shares. But for managed funds, the distributions are obviously driven by the underlying payments from the companies that are paying dividends. But even if the companies aren't paying dividends, the portfolio manager can maintain the distributions by selling some of the units, and the investors can do the same. So give you an example, quite a few of my clients, when they reach retirement, they obviously have a meeting with me, and we review as to, okay, the income part is now not there in terms of their salary. How do they maintain their lifestyle? So they would obviously be getting some super if they are over 65 from New Zealand government, and then on top of that, I help them determine the type of the level of income that they need from the portfolio. And that could be anything. For some who live, rather modestly, it could be something like 20,000 on top of super. For others, they might need 100,000. At the end of the day, the managed fund portfolio can be customized to generate whatever income the client wants, and that can be paid out in a very systematic manner with as much customization as possible. So some might be wanting income to be paid out on a fortnightly basis, some monthly, others would want quarterly payments. Whatever that frequency be, it can be put into the system, and it can be delivered upon without fail. So that's a really big plus for managed funds, the diversification, the liquidity, as well as the ability to generate passive income along with the capital gains.
That's great. Thanks, Shahrukh, for your wealth of knowledge there. That's quite an eye-opener. And I think that reminds me of one thing, no investment is ever risk-free. The closest thing that you can get to free lunch is diversification. Now I'll come to you, Lisa. So we've explored different options, for investors who want to beat inflation, get ahead. There are options such as residential investment property, commercial property, directly held shares and bonds or a managed portfolio, I'll cut the term deposit out because it's eroding purchasing power. So I think it's time to draw on your experience as a leading wealth educator. What do you think investors should consider when it comes to determine what's the right type of investment for them?
Yeah, and I think, look, I always take a bit of a financial planning approach to things. And look, property investors have had a pretty hard life in the last few years with a whole series of regulatory changes with the recent, hammering with the tax changes. And, it's a time when I talk to a lot of investors and people are kind of freaking out going, oh my gosh, what do we do now? And I think it's whether it's this or any other changes that happen in your portfolio, you have to take a step back and go, okay, well, what are we actually trying to achieve? And building wealth for most people is not about amassing a large amount of money. It's more about creating a lifestyle that they want, not only now, but into the future as well. And it's interesting because, if I look back at some of my older clients, they live on the smell of an oily rag and go into retirement still living on the smell of an oily rag, thinking, they need to have enough money to save for that rainy day, which, could be an absolute catastrophe. Whereas young people, you're almost kind of like, chasing them with a stick to tell them to hurry up and save something for the future because they're going to be as poor as church mouse, when they do get to that retirement age. But so I think it's important to go, well, where am I today financially, and work out what your net worth is today, sort of your assets minus your liabilities. Then go, okay, well, where do I want to be at what point in the future? And I guess, going back when I first started in financial advice, which is sort of 25 years ago, I found people were a lot more of in a hurry to get into retirement, and retirement had a bit more of a traditional viewpoint, like, get to the age of 65, collect the New Zealand super, sit in your recliner chair with the TV guide, and you're kind of, you're good to go. Whereas these days, people are living, to a lot older ages, and I've got friends in their 80s who are as sharp as I am, but they, they live very, very full lives. So we have a lot of life past the age of 65. We also live in a time where we've got significant advances in technology, so remote working. So, retirement is quite a different sort of landscape than maybe what it had been in the past. So that comes into thinking about what is that lifestyle at maybe, sort of 50 to 60 versus 60 to 70, etc. So I think that's something to really think about. And it's something that I've tracked very closely all of my sort of adult life, is what is my net worth. So I go, I can see how I'm progressing financially. And I think a couple of concepts to consider as part of this is the accumulation versus deaccumulation approach. Because as we're sort of younger in our working life, we're all about accumulating wealth. And property has been a fantastic tool in the past for accumulating wealth, predominantly because of the leverage. I guess there's two really key things: is the leverage, which part of it's been taken away with these tax changes, and the other thing is being able to add value. So those are probably the two drivers that makes property investments stand out from other investments. A lot of my clients, a lot of people don't want to put that effort into, to adding value. So that is obviously could be a bit of a moot point, and obviously the recent tax changes. But what I'm having lots of conversations with my clients recently about is, once they're getting to that point of retirement age, is going, maybe do we need to be talking about a deaccumulation strategy? Right, which is a very, very hard thing to get your head around. And that kind of follows on from what Shahrukh was saying, is that with a sort of a managed portfolio, you can actually potentially get a better income. Now, to give you a really good example, I've got a client of mine at the moment, and to keep the numbers pretty simple, and they're pretty close to this, they've got a home worth around $1 million, and they've got 2 rental properties worth about $2 million. Right. So in a couple of years, they'll have them all paid off. So they'll have a freehold home, 2 rental properties. And I said to him, okay, well, what kind of income would you get? So we worked it all out, and we worked out that his taxable income was between $30,000 and $40,000 a year on that $2 million of property. Because they bought them in, ages ago for a couple $100,000, of course, and so the income ratio on them was quite low. So, and depending on the year of maintenance, so $2 million of property, $30,000 to $40,000 of pre-tax income. And then I said, okay, well, if you put $2 million into a portfolio, which is a sort of a range of investments, you could draw, maybe 70 or 80 or even 100 grand of income per year out of that portfolio. Now, obviously the key difference is that with your property, whilst your income is low, your asset keeps going up in value, right? Whereas with a portfolio, you may take enough income so the value actually goes down in value. So, and some people go, oh, well, how, that doesn't make any sense. But does it or doesn't it? Because it does from the perspective as if income is your goal, because that's the other thing. When you're in an accumulation phase, building equity is actually quite key. I mean, building income is part of that, but it's sort of the equity side of it is almost the number one. Once you get into that retirement phase, income becomes more important.